All right, welcome to the Explainer. Today, we're going to talk about a Nobel Prize winning idea that completely changed the game for investors. It's called modern portfolio theory, and it's basically the science behind building a smarter portfolio.
So let's just jump right in. You, me, every investor out there, we all face the same huge problem. There's an ocean of choices out there, stocks, bonds, you name it, and a very real fear of making a bad call. So how do you even begin to sort through it all and manage your risk?
The thing is, it's not just about trying to find the next big thing. The real problem is the sheer number of combinations. With thousands of different assets, the number of ways you could put them together in a portfolio is, well, it's practically infinite. Just think about it for a second. Let's say you want to make an 8% return. Well, you could try to do that with a portfolio stuffed with tech stocks. Or you could use a mix of bonds and international stocks. See? Same target, but the amount of risk you're taking on, it could be completely different. So the real question is, how do you find the absolute best combination?
So how do we solve this? Well, the solution starts with a concept you have definitely heard of before. But its true power is actually a mathematical certainty. And we're talking about diversification.
Yep, it's famously called the only free lunch in finance. And why is that? It's because it's one of the only strategies that lets you lower your overall risk without having to give up your expected return. That's a huge deal. An entire theory was built just to figure out how to find that perfect balance. And that brings us to the main goal here. What we're trying to do is build what's called an efficient portfolio. What does that mean? It just means that for whatever level of risk you're comfortable with, you're set up to get the absolute highest possible return. No wasted risk. You're not taking chances you're not getting paid for.
And look, this isn't just some vague financial philosophy. Back in the 1950s, an economist named Harry Markowitz came up with a way to actually map this all out mathematically. It's this really brilliant two-step process. First, you let the math do all the hard work. It looks at all your potential investments, figures out how they tend to move in relation to each other, that's the covariance part, and it spits out a list of all the absolute best, most optimal portfolios. Then, and this is the important part, then you come in. You look at that pre-approved list of best options, and you pick the one that feels right for you and your personal comfort with risk. And what you end up with is this incredible visual, a map called the efficient frontier. You can really think of it like a boundary line. It's the line that separates the smart, optimized portfolios from everything else. And this is so important. If your portfolio is anywhere below that curve, it means you're being inefficient. You're taking on more risk than you have to for the return you're getting. There is always a better option up on that line. It really proves that just owning a lot of different things isn't enough. They have to be the right things in the right combination to get you onto that frontier. Okay, so let's be real. The full-blown Markowitz model is a beast. Calculating how every single stock moves in relation to every other possible stock, that's a ton of math. So to make this stuff actually usable in the real world, a simpler approach called the single index model was created. So instead of that crazy spiderweb of calculations, the single index model does something much smarter. It just compares every single investment to one big benchmark, something like the S&P 500. It's a fantastic shortcut that makes this whole powerful theory accessible. But here's the really cool part. This simpler model gave us something huge. It gave us a brand new way to think about risk itself by splitting it into two totally different buckets. The risk you can actually do something about, and the risk you're just stuck with. And this simple little formula, honestly, it's one of the most powerful ideas in all of modern finance. It tells us that risk isn't just one big, scary cloud. It's actually made up of two very distinct parts.
Okay, so let's break this down, because this is the whole game. On one side, you have unique risk or non-systematic risk. Think of a bad earnings report for one company or a product launch that flops. It's specific. This is the risk you can get rid of. You can diversify it away. That's your free lunch. On the other side, you have market risk or systematic risk. This is the big stuff: recessions, interest rate changes, global events. It hits everybody, and there's just no hiding from it. You can't diversify this away. So, you might be thinking, this is all for super high-level finance pros picking individual stocks. But actually, no. Its most common use, and probably its most important use, is way, way bigger picture than that.
For pretty much everyone listening, this is where the rubber meets the road. It's not about the crazy, impossible game of finding the next hot stock. It's about asset allocation. That's the real decision. How much of your money you should be in big categories like stocks versus bonds? How much in the US versus internationally? How much in real estate? Again and again, studies show that this high-level decision has a much bigger impact on your results than trying to find one or two superstar stocks.
Okay, so we've been saying that diversification can wipe out that company-specific risk. But how well does it actually work? A simple visual makes it incredibly clear. All right, so let's do a little thought experiment. Imagine you're building a portfolio from scratch. You buy one stock, then you add a second one, then a third. What's actually happening to your total risk level as you add each one? When you own just one stock, your risk is through the roof, right? And you can see it's made of those two parts we talked about. You've got that base layer of market risk, plus this huge chunk of unique risk that's all tied to the fate of that one single company. But now watch what happens. The moment you add a second stock, and a third, and a fourth, especially if they don't all move in perfect lockstep, you start to see that unique risk just melt away. The good news from one company starts to offset the bad news from another. They begin to cancel each other out. And it turns out there's kind of a magic number here. Research shows that once you get to about 20 or so well-chosen different investments, you've pretty much wiped out almost all of that unique, diversifiable risk. Yeah, you can add a 21st stock, but the extra benefit you get is tiny compared to when you went from one stock to two. So what's left over? That risk that just won't go away no matter what? That is pure market risk. It's the cost of admission for being an investor. It shows that diversification is incredibly powerful, but it's not a silver bullet. It can protect you from one company going under, but it can't protect you from the whole market having a bad year. And that really leaves us with the one big question you should be asking about your own portfolio. Is it actually diversified, or is it just crowded? Because, owning 20 different tech stocks that all go up and down at the same time, that isn't diversification. That's just putting all your eggs in one basket. And understanding that difference, well, at the end of the day, that's the real foundation of smart investing.